Before I proceed, I gotta put the disclaimer up just to make sure you understand what is happening with our video blog today. Good afternoon and welcome to another edition of Tony's Thoughts, July 2012. I finally have some positive news for you. The TSX and the Dow Jones had a great month. They rallied behind the positive news that's coming out of Europe. In the news this month, there's been an abundance of articles written about the real estate market in Canada, the crisis that's happening in Europe, individual debt loads. So I thought I'd pick and choose my favorite ones. The first one I read was RBC indicating from their research there's no bubble in the condo market. They believe that there's a strong enough demand, and with interest rates being so low, that we can continue to have these prices increase over time without having a bubble bursting. Now, they do indicate that there might be a small little dip in pricing, but they believe it's going to be something small, short, and be over and done with quickly. And they also believe that a lot of the investors that are holding in Toronto are going to hold long term. Now, the very next day in the same newspaper, the Capital Economics Group came out with their own article, with their own research, saying they believe there's going to be a 25% decrease in housing prices over Canada on average. And they believe that there's going to be most certainly a bubble in Canada. They're not saying today, tomorrow, next month, but they believe at some time it's going to happen. They attribute this to the new rules in the mortgage industry, how it's been tightening up, and how first-time home buyers can't get into the market as easily as they could 4, 5, 6 years ago, and therefore decreasing home prices. Now, I want to make sure that you are aware that I don't believe in any one of these articles. I'm just putting it out there so you understand. There's a huge amount of research to be done in the market, and every person has their own opinion. These are just two groups, but I do want you to make sure that when you are reading these articles that you understand that there's going to be another article the next day that talks about something else. So please, when you're reading the newspaper or listening on the radio, take the information in, discuss it with me or discuss it with someone, preferably someone with some experience, and then absorb it. Don't go out and make any rash decisions or go sell your houses or go buy a bunch of houses. Just make sure you do everything slow and steady and you think it through. The second article I wanted to go over with you today is Bank of Canada warns again that household debt are too high. They're actually at an all-time high. They've soared to 152%. And they attribute this to the ultra-low borrowing costs. So I want just to make you aware that because there's 0% financing on vehicles, or because you can buy a couch and pay, get it now and don't pay for 90 days or 9 months or 18, I don't even know what they are right now. But I want you to be aware that at some point you have to pay this. I've been seeing a lot of budgets lately. I've been seeing a lot of people's income statements, and I can honestly say that people are spending more money now than they have ever. So I want you to be aware that even though interest rates are cheap now, please be sure and please spread the word. Make sure your kids or mother, father, brother, aunt, uncle, neighbor aren't going out. I'm not saying to be a dictator and say don't spend money, but educate people and think it through before you won't go and use your credit card or your debit card. Bank of Canada is warning this. At some point in time, this is going to come to fruition, and people are going to be like, oh man, my interest rates are way too high. I can't pay for this, and that's going to hurt the economy long term. But if we start chipping away at our debt today, we're going to have a very positive future. The last article I want to go over with you is, to me, the most important one out of all of them. Carney again warns that falling oil price could grease the slide in Canada, which all he's saying is because people are spending so much money now, there's not going to be the demand anymore going forward to keep spending money. And he believes the first thing that's going to take a hit is oil prices. As we've seen in the last couple months, oil price has been taking a hit. Year to date, it's taken a major hit. So the energy sector in your portfolios have been on the decrease. Even though your portfolios are up year to date, a portion of that is being affected by oil prices. So what I want to do is I want to have a discussion with you over the next 2 or 3 or 4 months. As you come in and we sit down individually, I want to start removing some of the oil exposure in your account, because as Carney says, and as I'm starting to believe too, oil prices might take a little bit of a hit over the next year or so. So let's be a little bit proactive, let's reduce the exposure in the account, and let's be smart about our investments. A couple of key indicators I want to go over with you this month was Canada and US GDP. Canada's GDP in March was 1.6%. Now it's increased to about 2%, which is a fantastic increase. This is actually the first time this year that the GDP is at 2%. Our friends south of the border haven't been so lucky. Their GDP went from 2.1% down to 1.9%. A couple reasons for this is Canada in the last quarter has added 120,000 jobs, which isn't too shabby. I'm actually very impressed. And that's brought our unemployment rate from 7.3 down to 7.2. I'd like to see in a 6.2, 6.3 range, but we're on the right track to where we want to go. Unfortunately for the States, it's been a little bit different. They were at 8.1 and they've actually retracted. They've actually given up some jobs, which they're sticking around 8.2. However, that's a pretty good mark considering it wasn't too long ago, it was around 9%. The TSX is up about 3 3/4%, and the Dow is up 1 1/4% approximately. For the year, that makes the Dow up almost 7%, whereas the TSX is still down 1.5%. Kind of give you a little understanding behind that. Back in 2008, when all the financial crisis came out, the Dow took a huge hit. Now it's on the road to recovery, and that's why we're seeing a little bit of a higher return. Whereas the TSX took a big hit, but it took a gradual hit, and the prospects of it going up are a little bit less than the Dow Jones. But this is positive news of what's happening lately. It seems that everyone is starting to realize that this is a major problem and they're tackling it head on, which is very positive for the economy. Thanks again for listening to this edition of My Thoughts. If you have any questions or concerns, please let me know. Also, if you have any anxiety about the markets, the ups and downs and the swings, please let me know. Let's sit down, let's go over your risk tolerances again, and make sure that the portfolio you're in today is a portfolio you want to be in. As always, if you have any questions, let me know. Thanks and have a wonderful day.